Hi everyone, thank you for joining today's webinar, Digital Lending and What Does It Mean for Financial Service Providers. My name is Priya Punathar and I will be moderating today's webinar. We are very much looking forward to discussing digital lending. We have Victoria White, the Managing Director of Global Advisory Solutions here at Accion on the line. She'll briefly introduce the topic and why it is top of mind for us today. And we also have Paul Lamont on the line, our Director of Digital Africa, who is our expert on digital lending and who will be leading today's webinar. Before I turn it over to our speakers, I just have a couple of housekeeping items to discuss to make sure that we're making the best use of our time here together and that everyone can actively participate in the discussion. Right now, everyone is muted so that we can avoid background noise during the presentation. You will see on the screen now a screenshot of the menu that you should see on the right-hand side of your screen. You will see that there are two ways to ask a question. The first is the hand function. You can click on this to indicate that you are raising your hand. Feel free to click on this if you have a question or comment, and we will call on you at the end of the presentation. You can also use the question box that you see on the right-hand side for your questions. Simply type your question into this box, and I will relay the question to Paul at the end of the presentation. You should also be able to see a document on the right-hand side. That's our most recent publication entitled Demystifying Digital Lending. With that, let me turn it over to Victoria White, the Managing Director of Global Advisory Solutions at Accion, to introduce today's topic and our speaker today, Paul Lamont.
Great, thank you, Priya. Just to check, can you hear me?
Yep, you sound great.
Great, okay. Well, welcome everyone. Good morning, good afternoon, good evening, wherever you may be, to today's webinar on digital lending. What does it mean for financial service providers? Just briefly to kick off the session today, I wanted to place the topic within the framework of how Accion looks at financial inclusion. And as a mission-based organization, really committed to building a financially inclusive world, Accion has spent the last 50+ years trying to bring quality financial services delivered at lower cost, kind of those twin ambitions, to the underserved, and doing so sustainably. Yet historically, I think, and as many of you can relate, and even today, so many of the business models that are serving this market segment have involved very labor-intensive, time-intensive manual processes. I think we're all familiar with the detailed ledger books, the time intensity of doing underwriting, understanding the client risk, and all of the questions that need to be posed to get at that key issue. And all of that really makes it hard to scale, to really meet the enormous demand that still exists in the market today. That said, many of these business models now are starting to evolve. Improved connectivity, increasing availability of customer data, new technologies, all of these are changing the way financial service providers go about the overall lending process, the way they acquire clients, the way they underwrite clients, service them throughout the life of the loan, and continue to engage the customers post-lending as well. So digital lending, as we'll hear more about today, we really feel offers the opportunity to really achieve those twin ambitions of both better quality and lower cost, offering customers more convenient, faster, in many cases more personalized experience that can really then build long-term engagement post even the lending process. That said, digital lending, I think also we need to be cognizant of the risks and the challenges that come with that, and the often unanticipated effects on both the institution and the client. Financial service providers really need to kind of carefully and systematically approach the product design and development, really understanding client needs, market trends, really ensuring that they have the right systems and processes in place. And really digital lending, given all that, has really become, over particularly these last few years, really a core area of focus for Accion's advisory work. And many of these opportunities and challenges have been captured in the latest publication that Priya mentioned, Demystifying Digital Lending, which, as she noted, can be accessed at the right-hand side of the webinar screen. So to really help us demystify this topic on digital lending, I'd like to introduce our speaker for today, Paul Lamont, who is Accion's Director of Digital Solutions and the lead author of this paper. Paul currently supports a number of our portfolio companies as well as other partners in the industry with designing digital strategies and also helping them launch digital products. Before Axion, he helped build a microfinance business in East Africa and also worked at Leapfrog Investment as an operational lead on a number of transactions. So with that, let me hand it over to Paul. Thank you.
Great, thank you, Victoria, and welcome everyone. Great to have you here today. As Victoria said, my name is Paul, and I'm here to discuss how FSPs can drive their digital lending in their product offering. All right, so Priya, just in terms of a little bit of admin, I can't seem to change the slide.
Paul, we can do that on our end.
All right, great. If you could do that, if you could change that over now, please. All right, great. So I think just to start off, it's important to recognize that it is difficult to make sense of what's going out there. You have the banks that are apparently going to be taken out by the telcos. You've got the telcos that are up against a host of these specialized fintechs that are all focusing on specific parts of the value chain. You have global tech companies like Amazon and Facebook that frankly have unrivaled digital distribution and customer data. And the early signs that they're starting to offer digital financial services, which is very interesting. And then you've got cryptocurrencies like Bitcoin that these technologies can be built on. So it's no surprise that we're seeing a lot of CEOs and board members for that matter as well of FSPs that truly are confused about what digital is and what the first steps are that can be taken to drive digital transformation. Priya, if you can just move to the next slide, please. All right, so to start this webinar off, I'd like to run a quick poll, and Priya will manage this process, and you should be able to share your views. But what I'd like to ask is, in terms of how FSPs can be dealing with digitization, really, how should they be adapting in this changing landscape? Can they survive without digitization, purely because of their strong distribution and brands and physical touch points as part of their model? Should they look at driving solely internal efficiencies or digitizing their existing product features? Should they aim to offer new digital customer-centric products? Or should they look to evolve and compete ultimately with the offerings of fintechs? So I'm going to give you all a few seconds just to answer that poll and see what we come up with. All right, Priya, you seen those results? All right, interesting. I'm very, very pleased to see this, which is fantastic. So the results are coming through quite clearly. 83% of you out there are saying that really FSPs should offer to launch new digital customer-centric products. And I'm very, very pleased to hear that, because I think that's very much in line with Axion's thinking. And you know, we're going to dig a little bit deeper into this later. Interestingly enough, you know, in terms of competing with fintechs, I am a little bit surprised to see how low that is. Nonetheless, that's something which we'll dig deeper into this discussion, but I think is very realistic. So that's very interesting, and yeah, I think it's going to be very aligned to what we're going to discuss today. Priya, if you could just move to the next slide, please. All right, so just to start off, I think clearly we are seeing trends globally in emerging markets that are supporting the rise of digital lending. In Latin America, we're seeing examples are e-invoicing policies in countries like Brazil, which are being a strong enabler of supply chain financing. In Africa, we're seeing some great innovation in the fintech space. Admittedly, I'm probably a bit biased on this. But despite that, USSD is still a strong medium to interact with customers. And then even so, when you move out of the cities, customer sophistication can limit digital interaction. So there becomes this need for physical interaction, yeah, even for digital financial services. In Africa, mobile money is still continuing to be a very effective enabler of digital lending due to the high coverage of MNOs. And as a result, MNOs are still playing a central role in the delivery of financial services across the African continent. In India, Stack has been considered a game changer for digital financial services, although there has been a bit of a painful transition, enabled by Aadhaar, which, in terms of eKYC and e-signature, I think is extremely progressive. Generally, we find smartphone penetration and use in India is higher, much higher, for example, than Africa, and this is really driving digital services through smartphones and so on, which is, I think, very, very exciting as a backdrop. China, a very interesting market. I'll take for example, merchant acceptance of QR codes is extensive, which is extremely is a fantastic basis for digital lending. A number of non-banking giants are playing in the lending space, like CreditEase and WeChat, which is not typical in terms of, you look at Africa, it's predominantly the banks which are focusing on a lot of these services. And interestingly, in China, customers have a high willingness to share personal data, which I find very, very interesting in comparison to other territories that we work in, where sometimes it's very difficult even to have a telephonic conversation and to get information on a one-on-one basis. So, that certainly does promote digital lending as well. Priya, if you could move on to the next slide, please. Great. So, as we start, I think it would be helpful just to define what digital lending is. I'm going to move through this quite quickly, but it is an important step. First and foremost, we define digital lending as loans that are applied for, dispersed, and managed through digital channels, where lenders are using digitized data to inform credit decisions and build intelligent customer engagement. Now, CGAP did a definition of this a while back, which I think is fairly useful at this stage to use. And really looking at traditional credits in loan turnaround time, you're looking at days, if not weeks. The credit underwriting process is manual with a lot of human judgment and paperwork, and the account management process is, typically in cash, in person, at a branch or an agent. Digital credit, in comparison, in its purest form, is instant. The process it's using data-driven processes which are completely automated, including the underwriting process, which is leveraging digitized customer data. And the account management payments process is remote, enabled by cellular networks. Now, an important distinction that we make at Axion in terms of digital credit or digital lending is we define that in terms of the customer experience. So we don't necessarily look at the functionality of a lender and say, if you are implementing, I don't know, let's say scorecards at the application stage, for example, that counts towards your digital lending development. It really comes into how is that improving the customer experience, whether that is less physical documentation, increased access to customers that have very thin credit files, more personalized products and pricing, removing the need to move into branch, etc. But that is very, very important when defining what digital lending really is. Priya, if you could move on, please. Great. There's a variety of lenders out there in the digital lending space. I don't want to go into all of the detail here. This is in the digital lending reports where we really do dig a little bit deeper. But just to include a few here. I think some of the more well-known fintech lenders, is the online lending model, such as Tala or Branch in East Africa. Really typically offering a lending product through a mobile app, an Android app. We're also seeing, as I mentioned earlier, e-commerce platforms such as Amazon and WeChat, which we feel are a very interesting entry to the digital lending space, given their brands, their digital distribution, and their deep customer data, and certainly one to watch out for. Mobile money lenders typically is a partnership model between a fintech and an MNO, which remains a very effective way to drive financial inclusion to low-income customers, and we've seen a lot of success in Africa in particular. I think a point to make here is that these business models are constantly changing. Digital lenders are entering the ecosystem. They're defining themselves in terms of a specific functionality. They're widening that functionality. They're narrowing that functionality. They're changing that in order to find their commercial feasibility. And so this type of exercise needs to be done fairly frequently, because we find even the relatively well-known fintechs out there are certainly changing quite a bit. So it does make it a little bit more challenging. Priya, if you could move to the next slide, please. Okay, so what I would like to do is just take a look at 3 specific digital lenders and what are the commonalities across them. So I've got Tala, which is an online lender, as we mentioned earlier. QuickCash, which trades in Nigeria. We've defined it as a P2P platform. What it really is a platform that sits between banks for wholesale funding and offers effectively nano loans to customers through outbound marketing techniques. They score the customers. They take actually all the risk on lending to the customers and guarantee that the banks who they receive their wholesale funding a set return. And then Lydia is also in Nigeria, is a supply chain lender, which effectively works within supply chains and provides stock financing for SMEs. So at the customer acquisition level, all 3 of these lenders digitize their data at acquisition. In QuickCash's example, they partner with MNOs and they create that customer data and prospect data before they've even targeted the customer. They can pre-vet that information and they can create an offering to that customer before they've even contacted that customer. In the scoring and analytics space, this is really where these lenders do claim to differentiate themselves through a variety of ways. Namely, it's a fully automated process. The number of data points that they source for the customer is thousands, if not tens of thousands. For example, Tala, the app that they use the user will download that app and it will scrape a number of data points, including SMSs, call data, etc., to create a customized offering to the customer. And based on how much information the customer is willing to provide, that will affect the offering to them. And then the quality of their scoring algorithms to assess customers' willingness and ability to repay. All these lenders will state that they are using very sophisticated algorithms to do so. And whilst it is difficult, I think, frankly, for us to gain a lot of accuracy in terms of these claims, it is recognized the methodologies that they're using are certainly best of breed, and they're using machine learning, AI, etc., to gain an understanding of the customer's affordability. On the disbursement side, these loans are often being dispersed within 60 seconds. I mean, I think this is really exciting, and this is something that FSPs certainly should be aspiring to. Tala, for example, once a customer has applied, they can expect their mobile money account to receive the funds within 2 minutes, which is very, very exciting. On the collection space, a lot of these lenders are using quite innovative data-driven mechanisms to drive repayments. So let me give you an example. Lydia has a tripartite agreement with the supplier of their customer, who can coerce repayment from from the customer if they're in default, by having their supplier restrict their supply of stock, which doesn't require blacklisting at a bureau, etc., or anything like that. QuickCash, and I do invite you to read the T's and C's, because if you read it, it becomes quite clear, but they reserve the right to contact the most phone numbers of the customer by virtue of their partnership with the customer's MNO. So they can actually go out and contact your family and friends and say you haven't paid you haven't paid your due repayment. Now, this is not something that we necessarily agree with in terms of the ethics behind that, but really just it is an innovative mechanism to coerce repayment, and I think that that's certainly something which, as you design a more remote business model, is something which lenders should certainly consider. And then finally, customer engagement is fully digital in all cases. Tala, for example, they have no physical branches or networks at all. You can go into, I've been into a number of online forums, and you see customers complaining, saying they want to walk into a branch and speak to someone. But that's something Tala's not willing to do. They have created a fully digital model, and this is the way that their customer engagement needs to be to support that model, which I think is very interesting. And QuickCash and Lydia, almost all issue resolution can be done telephonically or through in-app messaging and so on. So the reason this is important is that these fintechs are offering their products to the same customers that FSPs serve, and so customers' expectations are changing. If a customer can get a loan with a turnaround time of a few minutes or hours, and the application process is easy, they will start expecting this from their competitors. And what we're seeing in a lot of markets is that fintechs are starting to offer increasingly larger loan sizes. So they're showing signs of competing with traditional FSPs. And I've spoken to FSPs, and this is a very scary prospect. Too many FSPs who don't feel that they are necessarily digitally ready to offer similar kinds of products in terms of pricing, loan sizes, etc., and just the sheer digital delivery of these products. Next slide, please, Priya. But I don't want to paint an overly scary picture, because I think if we take a step back and look at the context, there's a huge opportunity out there for FSPs. Nadeem Sheikh, CEO of Anthemis, pointed out some recent research by McKinsey that profits of traditional lenders and banks risk falling up to 60% within the next decade if they do not ride this wave of digitization. But the reality is that these fintechs will not rise alone due to regulatory constraints and a number of local factors which make FSPs extremely relevant. And for that reason, there is this huge opportunity for FSPs if they can adapt digitally. So the real question does become, how do FSPs respond? Next slide, please, Priya. So our experience is that FSPs do face a number of challenges in implementing digital lending, and these are driven both by internal and external factors. I'm going to move through this fairly quickly, but I do think it is important. Internally, lack of product differentiation, not being able to design products which are more customer-centric, can be a real challenge in limiting the benefits of digital lending. A lot of FSPs believe that if they just simply automate their processes, that will drive a lot of efficiencies. But the reality is that those processes must be efficient themselves and designed accordingly to maximize the customer experience. Importantly, a lot of FSPs are incapable of managing their data properly. They don't necessarily have a data warehouse in place. API integration is a problem, and that becomes very limiting when we need to have a single view of the customer. We need to work with third parties and share data. We need to be able to draw insights on our customer behavior to refine our product structure, etc. Poor tech and touch structure can be an issue, because what we see is a lot of FSPs think digital is just digital, and that doesn't mean that we need any physical branches or anything. And the reality is, in a lot of the emerging markets that we operate in, there is very much a need for physical touch. And so understanding that and modeling that and pricing that into an expansion strategy is very, very important. Also, loss of staff accountability and insight, specifically as FSPs start centralizing their credit decisioning process. In a lot of businesses where they are reliant on the loan officer model, where loan officers very often have quite a lot of power in deciding in pre-vetting customers and even vetting customers to be onboarded as a customer. As that is centralized, a lot of lenders receive a lot of kickback from their agents. And I've seen FSPs that are scared to drive digital change because they can see that there's going to be, for lack of a better term, a mutiny across sales agents, and that's a problem that needs to be managed correctly. And giving into that resistance is really a huge obstacle for digital transformation. And then finally, and I would say arguably one of the most important factors, is restrictive organizational skills or culture. So obviously, first and foremost, there needs to be a very strong support from senior management, but also skills within the business to drive the type of catalytic change that we're talking about. And that can be very challenging in terms of finding a number of skills across many functions to drive digital change. And then externally, other issues which we see is finding and operating with potential partners because of different cultures, different systems, etc. Working with FSPs, working with fintechs is not just necessarily a marriage made in heaven. It does often need a little bit of management from our experience. And so we've seen a lot of partnerships fall apart because there hasn't been enough focus on managing the actual relationship up front. Regulation in a lot of these markets is also changing. Regulators are finding their feet, and that adds a lot of risk to launching these products. And then finally, customer sophistication can be a challenge as well, whether it's financial sophistication, specifically in more rural locations, and digital sophistication, where the customers actually have the tools to be able to use financial services which are delivered digitally. All right, Priya, if you can move to the next slide, please. So this really was the thinking behind the digital maturity matrix that Action has developed, and it's one of the more central outputs of the digital lending paper that we've recently released. And the idea is that we look at digitization at 3 levels: early, base, and digital plus maturity. And each level is achieved by being able to deliver a certain level of digital functionality. So at early stage maturity, what we're focusing on here is access to financial services. It's really about driving the acquisition process and the application process through digital channels and allowing the customer to remotely manage core functions of their accounts, whether it's things like checking your balance, making a payment, or transferring or making a transfer. At base level, what we're looking at is lenders that are focusing more on customizing that financial service, and that largely speaks to the data analytics and insights, and very importantly, credit scoring of customers at the application stage and at the renewal stage as well. And so customers are starting to receive more personalized products, or they're receiving products that they weren't receiving in the past, because the lender can now analyze that customer on a more personalized basis. And then also the lender is starting to personalize its interaction with customers as well, based on their behavior or the insights that they have from their own data or from external data as well. And then finally, digital plus maturity are really lenders which are, these are what I would refine as or define as digital natives. These are fully digital business models that have been designed with digital in mind. These are lenders that are able to use best of breed data analytics and scoring methodologies to produce highly personalized products and experiences to the customer. When you start looking at the customer engagement piece, this is really where lenders are able to understand a customer on a very intimate level and start not only offering personalized products, but starting to understand customer behavior and starting to cross-sell, upsell products which are very specific to the needs of the customer. And then also create just sheer interactions which are more personalized as well. Next slide, please, Priya. All right, so this is the digital maturity matrix as it stands, and I'm not going to go through every single block here. I think what I would really like to focus on is the blue blocks, which are effectively the gating requirements for each level of maturity. So Priya, if you don't mind going on to the next slide, please. Great, thank you. So at early stage digital maturity, what we're really saying is that for a lender to reach this level of maturity, they need to focus on 2 key areas of functionality in terms of their product offering, and that is to have at least a partially digitized customer acquisition process or onboarding process. So what this really means is that the customer is at the very least providing some initial data to the lender via remote means. They may very well be a more manual or paper-based follow-up with more in-depth information, but at least there's that initial application stage which is remote and digitized. And core components of account management are digital, as I mentioned before. So they can definitely check balances, make transfers, and manage their accounts on a very basic level without having to walk into a branch. At base level, this is where, as we mentioned before, scorecards are starting to come into use. These lenders don't necessarily use multiple forms of data, external and so on. They might actually be using relatively limited data sources, whether that's just from the application form and a few other basic sources. But they're also enabling what is really mainly digital disbursement. So at this stage, you would expect the lender to be dispersing into a digital account, whether that's a money wallet or actually just a bank account that is set up for the customer when they've applied, and perhaps they can integrate into a payments platform and take that cash out at a third-party agent, if that is the customer's desire. And then finally, with Digital Plus, you really do expect the lender to allow or facilitate completely digital onboarding with no or extremely limited manual intervention at all. They're employing best-of-breed data analytics and scoring and highly personalized products to the customer. And really on the customer engagement piece, both in the way that the customer interacts with the lender and the way that the lender interacts with the customer, this is really almost completely digital. As we said before, implementing advanced personalized customer engagement. All right, Priya, if you can go on to the next slide, please. All right, so what we're going to do now is we're going to move on to just a few distinctions for FSPs implementing digital lending. And the first important point to state is that digital happens throughout the organization. We see, across a lot of our research for the digital lending paper, we came across a wonderful quote from an FSP in India, and he said to us, "We've seen a lot of lenders and startups that have a digital mullet. They look digital in the front, but they have a lot of labor-intensive work happening in the back end." Now, for those of you who don't know what a mullet is, you can take a look at the picture. It really is. It's a haircut where it's pretty clean cut on the sides and the top, and it's got this long tail at the back, and that really representing this non-digital back end. And I think it's important to recognize that this really isn't in the spirit of digitization. I would say one of the biggest problems we have with FSPs implementing digital products is that there's this lack of coordination across all functions in the business. For example, digital products very often require a physical touch point that requires alignment with branch managers, and making sure that and I say this in inverted commas, the digital team designing this new digital initiative is coordinating with the branch managers and the loan officers to make sure there's a consistent message and customer experience is very, very important, and often, and I've seen it lead to the failure of digital product launches. So that coordination is absolutely crucial. All right, Priya, if you go to the next slide, please. The next important distinction to make is that digital readiness is not digital lending. So we see, I think it's very important that a lot of FSPs, before they can launch their digital product offering, they need to be able to develop their digital readiness. And really, there are four main components of this. The first, and we've mentioned before, is a strong support from senior management. The second is a deep understanding of current and potential customer segments. Now, this is important if you want to design a customer-centric product. That sounds pretty obvious, but many FSPs haven't necessarily looked at their own customer and analyzed their own data and tried to understand what the behavior that their customers are displaying and what are the opportunities. So it seems like a real low-lying fruit, and it is, but it is very important as an FSP starts to design these more customized products. And then intuitive, clearly defined and mapped business processes. Again, this is a lot of hard work, and this requires, again, a lot of cross-functional collaboration, and it's often very difficult to implement, but time and time again, we have seen FSPs not do this and then come back to this and say, okay, let's map this out. And mapping out an entire process or many processes can delay a digital product launch by easily 3 to 6 months. So something we would always encourage lenders to have in place right away. And then finally, systems that are organized, accessible and accurate internal data, and are fundamentally built with scalability and interoperability in mind. And this speaks to the data warehouses and API management that we spoke about earlier. So the reason why this is important is twofold. Firstly, we see a lot of FSPs that try to skip this step and go straight to fully digital products and are forced straight back to make sure that these steps are in place. Or FSPs focus on a lot of the stuff, specifically data warehouses and so on, and they think that they are driving their digital maturity, but the reality is they're not. They are only setting the foundation, whilst that's very important, but they are not at all driving digital products at all, which is really where we need them to get to. Next slide, please, Priya. All right, so continuing this logic, we see a big difference between developing digital propositions and product propositions. So once you've got your digital readiness out of the way, the next step is really to develop digital propositions, which is the process of digitizing your current product range. This can be done in small steps. It can be done in one file swoop, such as starting with digital onboarding and then moving to automated scoring methodologies, etc. but that really is your existing product range, and it is a very important step. But it is not, as we saw in the poll earlier, this does not speak to launching fully digital products. And that really is, when you're looking at driving, product propositions, this fundamentally requires defining a new product based on the needs of the customer, and it's fundamentally built off these new digital tools that the business has acquired through developing its digital readiness. And again, what we often see is that FSPs don't appreciate the difference, and they assume that by offering the same product digitally, they're driving their digital lending agenda. We think it's very important to make that distinction, to say you're moving forward, but you're only halfway there. Next slide, please, Priya. All right, so as a follow-on from this, it also means that FSPs can plan their digital product offering at different levels. So this is an example of something that we're working with a client at the moment, the percentages are fairly arbitrary. So it's to set the trend and to understand the context. But when an FSP is building out how they are going to get to a very digital product, it's often very helpful to understand, okay, what are the various forms of defining digital over the next 3 years? And so with this specific client, we've sat them down and said, okay, you've got what we would define as fully manual products. There's a little bit of digital automation in these certain areas. Let's see how we're going to launch what we would define as partially digital products. So let's digitize specific parts of your existing product set. And then let's plan for the next 12 to 18 months, we're going to launch a mainly digital product, which is now based off more of a digital premise. There might be some physical interactions or touch points or non-digital elements, but it's definitely designed more off a digital premise. And then see whether it is possible to launch a fully digital product. And so what this does is it gives FSPs the recognition that jumping to a fully digital product, which is, I think, the tendency of a lot of people, it's very natural. They get very excited about saying, let's launch this digital product. But just understanding that there should be what I would say probably a 3-year roadmap to develop that functionality if we are starting from a fully manual product, and saying what are the products that we can enter into the market with that are developing our digital maturity over time, and move away from this tendency to focus solely on a 12-month budgetary cycle, which doesn't allow for that momentum through a much longer period. Next slide, please, Priya. So we've mentioned it before, but I think a very important point to re-emphasize is that we feel human touch will remain relevant to several markets, to many FSPs in many markets when implementing digital lending. And this can be because of the customer segment that the lender targets, whether it's because of their financial sophistication, their education, that they're not comfortable with understanding the actual product itself. They need to have someone to speak to understand the workings of the financial product. They might not have the digital sophistication. They may not have the hardware. They may not have the connectivity in rural locations. They may not be able to afford paying for that connectivity, that 3G. The customer may simply prefer a physical interaction. They might just be a cultural propensity to prefer. I think a good example is if you look at India, as I mentioned before, we are seeing that users are becoming progressively more and more familiar and comfortable by using financial services over apps and so on smartphones. But there is still a very strong cultural preference for the assisted model. And so that means that necessitates that touch point if you want to drive significant uptake in your product. The use of the credit, I think this is important specifically when we start talking about larger loan sizes, SME loans and so on. You start necessitating the need for physical asset checks, which do require physical interaction. In many instances, I've seen quite a few examples of this where even the customer, when they are receiving a larger loan, they prefer to look into the white of the eyes of a representative of that lender to gain some level of comfort, at least in the initial application. And so that does speak to these larger loan sizes. Just there's risk on both sides of for both parties, and they want to gain some form of mutual legitimacy. The lenders distribution network. Many lenders have very efficient, very extensive networks, and I think in that context, that's a real asset to an FSP. It really is, for all of the reasons that I've mentioned above. And so, we would not say to an FSP if they're launching a digital product that they should ignore that physical distribution, or that they should look to disinvest, at least not in the short to medium term. Which I think is a very different proposition if you're speaking to an FSP that has a relatively small physical footprint. Then the cost of setting it up setting up a branch network or an agency network is far more challenging. So that really does need to be taken into consideration. And then finally, a preference for cash, and this we see in many emerging markets. This desire to transact with cash, and if that is relevant in an FSP's trading environment, it will necessitate a physical distribution to enable cash in or cash out. And this can be driven through partnerships. So some FSPs can partner with agency networks or MMOs or what have you to enable that. But very often we find FSPs want to have control of this because of the challenging environments which many of them operate in a rural environment and so on. So it does typically mean that if this is the case in terms of desire for cash, FSPs will build their own network, at least to some degree, to support their digital lending agenda. And so FSPs need to manage the right mix of tech and touch as a core part of their digital strategy, and this has a lot of implications into branch investment or disinvestment, developing more centralized functionality like call centers and so on. And the first place that an FSP must start is designing the customer journey and understanding the customer's needs. It is absolutely so important, and we see it being missed. It's often a misstep and a crucial step in understanding how all of these different tech and touch steps are coordinated. Priya, if you could go to the next step, next slide, please. All right, and finally, I think it's very important to recognize that the delivery of digital lending products often require partnerships, given the specialization of many of the various functions in the value chain or the lending cycle. And I think a very important part of this is for lenders or FSPs to recognize what they are good at and what they're not good at. And so a discussion that we try have with our clients very early on in any discussion about digital transformation is, what are they good at? What is their strategy for partnerships? What part of the value chain or the lending cycle do they see themselves performing themselves, and what can they outsource? So I'm just going to discuss a few areas where we think there is a lot of value. I think first and foremost, customer acquisition and onboarding is an important area, given that as FSPs move towards digital lending, one of the big challenges that we see is that FSPs now, in their desire to drive efficiencies on customer acquisition, need to start creating their own digitized data. And for many FSPs, that's a big challenge. It's very difficult. They have built a business that is based on acquiring customers through a very physical means, through loan officers and so on. And so this idea of now trying to source digitized data to then go and contact customers, or to at least attract customers through digital channels, is a skill set which they don't necessarily have. And so we will often encourage FSPs to develop that, both in driving partnerships with MNOs and agency networks and so on, but also focusing on digital marketers and other kinds of resources that can attract customers through digital channels. In the scoring and data analytics space, I think the most obvious choice is specialist digital lending scorers, typically fintechs, who offer a full end-to-end solution for customers. That is, I think it's very helpful when an FSP is looking to de-risk a launch and is looking to reduce time to market, but it does mean outsourcing a key function as a balance sheet lender. So there are risks in managing that process, refining credit risk and the performance of the portfolio, etc. So we would always say that FSP should look to have skills inside its business at the very least, so that it can interact with these outsourced parties and frankly keep them honest. And then very quickly on disbursements, it's a low-lying fruit to be able to work with MNOs and payment platforms and so on to allow for that digital disbursement of loans and obviously repayment. And then on the customer engagement side, I think one of the biggest opportunities is really working with specialists that can help FSPs understand the behavior of their customers and design engagement strategies to support them and also help refine products. Next slide, please, Priya. Right, so if we were making recommendations to any FSP adopting digital lending, this is really what we would recommend. And then this is just a quick recap. We would say the commitment from the C-suite must be strong and critically must include the skills that can drive that catalytic change. Focus on digital readiness first. Make sure that the processes are refined and the data management is in place. Obsess over customer-oriented product design and experience, and make sure that products are simple and intuitive and based on customer needs. Embrace partnerships where they can sustainably enable digital lending and support FSPs over the long term. And make sure that a tech and touch approach is well balanced and very much based on the customer journey and the needs of the customer as well. Engage with regulators through all stages of the development. Whilst you're designing your pilot, whilst you are running your pilot and before your commercial launch, and frankly after, make sure that there are no surprises because that really can affect the efficacy of any digital lending launch. And then finally, build your digital product maturity over time. Don't expect this to be a magic bullet. Build it over a multi-year period and make sure that you've got clear milestones within that period that you are delivering digital functionality within each 12-month block. Last slide, please, Priya. And just so the last sentiment that I would like to end with today is, although riding this wave of digitization requires structured planning and a phased implementation, the opportunities for FSPs are very significant, both for their own growth, for customer experience, and also very importantly for financial inclusion. So with that in mind, my advice to any FSP would be start now. Thanks very much.
Great, thank you so much, Paul. We have already had several questions roll in, so I just wanted to mention for those that joined a little bit late, there are two different ways to ask questions. There's a hand symbol on the right-hand side that you can click on if you want to just raise your hand and we will call on you, or there's also a question box where you can type in your questions. And I realize that we have about 12 minutes left, and we have a couple of questions to address. So, for those of you that are able to stay on for about 10 extra minutes, we'll continue the questions till at least 10 after. So Paul, actually one of the first questions that rolled in was from someone who asked, so you had mentioned that in order to start offering digital lending products, strong support from senior management is required. But what if our institution does not have strong support from all members of our senior management, and how can we make this case to the naysayers within our organization?
Well, I mean, this is a very important point, Priya, and I think it works on a few levels. I think first and foremost, any FSP that is serious about digital transformation needs to have a CEO that is leader, that is driving that change, and in many ways that is the responsibility of the board. So at the first level, I would expect the board to be putting pressure on the management team and specifically the CEO. And at times that does mean making changes to the CEO. Frankly, I mean that would be an extreme case, but working with the CEO, coaching them, making sure that they see the benefits, etc., aligning incentives, all that kind of thing, I think is very important. I think within what the CEO can do, without a doubt, taking for granted that the CEO is not necessarily driving the day-to-day operations of the business. What we see as a very effective catalytic driver in digital transformation is to bring someone into the business that is familiar with a lot of these these new technologies and has experience in digital products. And what that really does is allow the organization to have someone who is comfortable with the concepts, has experience in launching these types of products, and in many ways is seen as, I would almost say, a deputy CEO. So you are looking at someone who's quite senior, who can drive that change, and make sure that that person has frankly a lot of sway across all functions in the business to drive it. In terms of naysayers, well, I mean, this is a bottomless pit, but at the end of the day, any business that's serious about digital transformation needs to make sure it's got the skills, it has the structures, and very importantly, has the incentives. And so, if there are naysayers there, ultimately, at least in the medium term, that means that individual's interests won't be aligned to the business and their own KPIs, which makes performance an issue and may result in that individual leaving, hypothetically. I will say though, I think that if you can get one individual that has a lot of that experience, there's huge opportunity for cross-pollination of ideas and coaching, etc., to drive a lot of that change.
Great, thank you, Paul. We got a question from somebody named Salim Dareda. I don't think they're on the line anymore to ask it themselves, but so I'll just read it. But they asked, in this example of quick cash, how does the FSP know phone numbers of family and friends of the client in order to contact them in case of the client's default?
All right, okay, that's quite just a quick one. So quick cash, really what it does is it works with customer lists that it gets from MNO. So it has, not only does it have a relationship with banks to provide the wholesale financing, they have relationships with Etisalat and a few other MNOs where they have access to the back end of the customer's call logging. So they don't need to scrape the data directly off the phone. They can work directly with the MNO to say, we know Paul, can you please let us know who are the top 10 numbers that Paul has phoned in the last, 30 days.
Great, thanks, Paul. Let's see, I'm trying to go through the questions. So we have one very good question from Mahmoud Hachicha, who asked, our microfinance institution is only offering fully manual products, but our strategy in the long run is to do digital lending. Do you think it is a good idea to create a new product purely digital to test it as a proof of concept, or do we need to proceed step by step?
I think that is a very good question, and we certainly do see some FSPs trying to experiment with certainly more sophisticated digital products in comparison to just digitizing their product offering from the start. I would think that you can run both in parallel, and in many ways, if you do drive a more digital team and a team that is driving the more existing product range, that's very possible. So I think it depends on the organization. I personally am very favorable towards experimenting with ideas as early as possible. It speaks to whether the organization, if it is very manual, can actually deliver on the product. Do they have a host of the digital tools required to deliver a fairly remote automated product? Generally, that is a challenge to jump to that, but if they start partnering with third parties, they can fast track that, as I said before. So my response would be, I think ultimately the best way would be to do both, would be to be piloting more sophisticated ideas, getting that proof of concept correct, and at the same time slowly developing the digital propositions of the digital functionality of your existing products as well.
Great, thank you, Paul. So we have a couple of questions here from Anis Alush. Anis, are you able to ask your question live, or would you like me to read your question? Oh, why don't I read it? So it looks like digital lending is a strong enabler for traditional banks to enter the microfinance segment, since the field aspect, which is used to be a competitive advantage for the MFI. So I think that was one of the comments. And then, could you give some examples on some markets where traditional banks or MNOs got in microfinance because of digital lending?
So repeat that question, please, Priya.
Yeah, sorry about that. So Could you give us some examples on some markets where traditional banks or MNOs got into microfinance because of digital lending?
Well, if I'm perfectly honest, it is almost impossible not to get into, not to use digital tools to get into microfinance. So I think this is a very blurry space. But you know, if you, for example, look at Mswari in Kenya, the ability to offer a relatively small size loan to customers which often don't have credit records, are often outside of the cities and more rural locations, but are within cellular coverage, I think is a very good example of an MNO that has partnered with a bank, in this case the Commercial Bank of Africa, to offer a product to a lower income customer. So it's interesting. I mean, I've never thought of it that way in terms of entering the MFI market, but yes, if you are entering into the low income market, I think you know, digital is absolutely crucial to enable that. I mean, another lender a fintech that I would look at is, you know, Tula, also actually in East Africa as well, focusing on providing inputs financing to farmers in rural Kenya. You know, that simply could not be done without technology. The entire business model is based off a mobile platform which allows the information flow between the lender and farmers in rural locations. So in many ways, I would struggle to find the reverse. I'd struggle to give you examples of more formal of banks or MNOs who are not being able to who are entering the MFI market without using digital tools. I mean, it is inherently where cost efficiencies come in, and very importantly, remote account application and management.
Great, thanks, Paul. We have actually two questions from Walid Ahmed, and so we're gonna unmute him so that he can ask his question live.
Yeah, hi, can you hear me?
Yes, hi, is it Walid?
Yeah, hi, how are you?
Yes, I'm good, how are you?
Okay, so I have two questions over here. First one is regarding the behavioral change. So when any FSP goes digital, there's going to be digitizing the internal processes, which will become some of the jobs redundant. So how do we go around and satisfying our employee base that it is for the best and no one will be losing job, if you know what I mean?
Yes.
And the second part is that from an FSP point of view, where do you think is a good starting point? Would it be from the customer onboarding journey, or digitizing the cash and collection process through mobile money operators? So what's the starting point for FSP who has absolutely no idea about digitization? Okay,
great question. So starting on the behavioral change, I think, you know, this is very specific to the organization itself. As I mentioned before, what we see is a lot of FSPs do take this approach where they try digitize their existing products in small blocks. So taking a specific functionality and say, let's digitize onboarding and so on, and also try launch a more digital product in a pilot phase. What that often involves is that the more digital product launch is often a completely separate team, right? It's composed of one, maybe two or three individuals that have often been brought into the business to drive a more digital agenda, with the idea that over time they will integrate into the larger business. If that is the case in that kind of environment, I think that it is a lot easier, because you've got this very, very digital product which is being launched by specific individuals who've been brought in for that agenda only, okay? And then you've got the larger business that you're trying to digitize. And so I think behavioral change and managing that change management becomes a little bit easier, because you can take your existing your existing staff base, and it's a case of, frankly, just tweaking their behavior to support this more gradual shift of your existing products. And that speaks largely to incentives, frankly. One thing which I am often disappointed to see is that CEOs try drive digital change, but they don't try change the KPIs and, frankly, the incentives. Now, if you take a step back, and if you're a CEO of a business that needs to change or recognizes that they want to digitize, the importance of digitization is arguably one of the most important items on their agenda in the medium to long term for that business. And if that is the case, the need to make sure that KPIs are aligned, that there are incentives to incentivize the right kind of behavior is very, very important. Now, I think if you take that kind of approach and you support and make sure that your staff base are trained correctly, that they have their incentives aligned, that they are seeing the benefits, I think it becomes a relatively easier discussion. However, there are sometimes staff that don't meet that criteria, and then you often have these issues where there's a lot of just discomfort and frankly resistance. Now, that is a challenge, and I would always say, as if you look at what you're trying to achieve and the scale of change you're trying to implement, it is very important to make sure that the vast majority of your staff are brought along. But if there are one or two staff members that can't find that change, that becomes a challenge, and that's up to the discretion of the CEO. On your second question, in terms of what are the obvious points for an FSP to drive digital change, if you look at the digital maturity matrix and you look at really what are you trying to achieve at that early stage maturity, I think there's three areas that come to mind immediately. Firstly, certainly driving digital onboarding. So whether that's via mobile app or USSD, or frankly even via SMS and a call center, just non-physical, I think that is very important. Or frankly the introduction of a digital field application with your sales agents. Now, that's not ideal because you're still using a sales agent in that example, but I think that's a very important step to digitizing data before the scoring process, and that will certainly improve turnaround times over time. The other opportunity is definitely trying to digitize your disbursements and your repayment process, making sure you've got an account that can receive mobile money or any other form of digital money in the territory in which you operate. And then finally, definitely trying to enable digital account management on some level. I mean, really trying to dislocate that relationship that customers have with loan officers and trying to see, can that customer perform certain functions without walking into a branch or speaking to a loan officer. And as I say, that could very much be just speaking to someone on the phone in a call center, but ultimately you want that to be more automated and have that via a USSD string or some kind of mobile app if possible.
Great, thank you so much, Paul. And so I know we're at the top of the hour. We have one more question to address, but if anyone else has any lingering questions, please feel free to send them in, and I think we could probably take one more after this. So Paul, this question is from Leslie Puth here at Axion, and just to warn you, I think this is a hard one. So,
oh goodness.
Yeah, so her question is on scoring algorithms. So since these are usually proprietary, and while the methodology may be somewhat visible, I imagine that much of the calculation is opaque. To what degree is there accountability to make sure that there is not inherent bias that may disqualify a class of potential clients?
Okay, so I mean, this is you can look at this from many angles. I think ultimately I take a very pragmatic stance. My view is that if you're looking at how more sophisticated algorithms can drive financial inclusion by opening up the lending market to customers that either didn't receive products before or received very, very bad pricing terms, etc. And then obviously you have to trade that off against, frankly, the profitability of the lender itself. So if they are implementing scoring algorithms that are inaccurate, simply their PAR is going to increase to the point where they are no longer financially feasible. So that really is the trade-off. Do I lose sleep at night whether a lender is not necessarily opening up its book to as many customers as possible? No, not at all. And the reason is, I think my view is that digital lending is so innovative in its way, and we're seeing so many new customers being offered financial services that the scale of that growth in itself, to me, is very impressive. We have not reached the level of saturation yet, and at the same time, every lender, I think, has the discretion to decide how they lend to their customers. If there is a bias in their algorithms, that they may be losing out on a commercial opportunity, frankly, if you're looking at this from purely a commercial feasibility perspective. So it's not something that I would say I'm overly concerned about. I think what is the trick for the lenders is if they get this wrong and they don't price their products correctly, if they do offer to customers that they shouldn't be, which is more often the case, can they be a sustainable commercial entity, and will they be around in 2, 3, 4 years time?
Great, thank you, Paul. So that's it for the questions. But Paul, if you have any, do you have any parting advice for us? Oh, actually, sorry, Paul, we got one more question. So, Anis, are you on the line still? Would you be able to ask the last question that you just sent in? Anis, you are now unmuted. Okay, I can just go ahead and ask it. So Anis asked, digital lending would reduce the load on credit agents. What would be the new activities that you recommend that they should be enrolled in?
What do I recommend that sales agents should be enrolled in?
Yeah, just given that the digital lending will reduce their sort of workload.
Yeah, absolutely. So from my perspective, I think the biggest opportunity for sales agents who have very strong personal relationships and they understand customers very well. I don't find it surprising, frankly, that so many senior management staff that in FSPs that we work with were originally loan officers, because of the insights that it gives you to serve your customers so well. I think the immediate transfer would be to centralize those roles into more of a call center environment and use those staff members in centralized sales efforts, and also in customer service centers as well. So if we move towards more of a centralized customer onboarding and customer management model, I think agents can, if they are put in call centers and work and are able to scale their efforts across a larger customer base, I think are very well suited for that role.
Great, thanks, Paul. And we have actually one final question from Saurabh Nandwana, who we will now unmute to ask his question.
Hey, hi, Neil. Can you hear me?
Yes, hello. Hi, Saurabh. How are you?
I'm doing good. So my question is particular to Indian geography. So currently in most of the India, the data, which is like the loan origination data, and the resources are not present everywhere. So because of this, self-onboarding is not truly justified, and in order to achieve leads and in order to get leads, the feet on street model, like you said, the salespeople and the LO people are like more and more in demand. So is there any way, or like how do you see that in near future this would be shifted to self-onboarding compared to this feet on street model?
So it's a great question, and it really is, it comes down to the practical challenges on the ground. And I think first and foremost, let me be very clear, whilst obviously the intention is to drive more digital onboarding and certainly acquire client data and prospects to be able to contact customers and attract customers through digital channels in an inbound manner, it is challenging, as you've said. Look, my view on the Indian territory in India in general is that I think India is more advanced in terms of its users using social media and smartphones and so on. So the ability to target MFI customers through social media, specifically when you start talking about the youth, is much higher than many other territories. However, and we see this in Africa a lot, which is obviously where I spend most of my time. We have to keep telling FSPs that you need to develop your ability to attract customers digitally, but at the same time, categorically, you can't exclude physical marketing efforts to onboard customers. And so right now, as we stand, you're absolutely right. We do see a lot of this. I think what is very relevant is to understand the trend and where things are going. any lender that is developing its physical agent network and sales offices more so than its digital infrastructure, I would just say, look, just make sure you're balancing that correctly, because we are seeing very strong trends which suggest that it is going to become easier and easier to attract customers digitally. And so I think this point was made when we spoke about the human touch. It's still extremely important, and is something which at the moment I'm not surprised to hear many FSPs are focusing on. However, given what we're seeing in terms of the background kind of macro factors across many territories, it is going to become progressively easier. And so I think an FSP needs to balance that, right, and understand, and like any commercial entity, understand what their cost of acquisition is. You know, if you are, let's take an example, if you're partnering with an MNO and your conversion rate on your outbound SMSs is less than 0.5%, it actually becomes very expensive. You're spending a lot of money per lead and you're not getting many converted customers. And it actually may ironically be more affordable to put a good sales agent on the ground, and they can attract 3, 4, maybe 5 applications in a day. So yeah, it's a bit of a balance, really, if I'm perfectly honest. I would just caution FSPs to constantly monitor that, you know, over the medium term, to make sure that they're not over-investing and that they're not missing the opportunity of digital customer acquisition.
Great, thank you so much, Paul. So we're now a little bit over 10 minutes in time, so Paul will relieve you of more questions. But I wanted to thank everyone that was able to join us today to learn more about digital lending. And thank you to Paul and to Victoria and the rest of the Axiom team for putting this presentation together. We also want to give a special thank you to the Citi Foundation, who made this presentation possible. So everyone who's still on the line, we look forward to seeing you at our next webinar, and we hope you have a great morning, afternoon, or evening, wherever you are in the world. Thank you all so much.
Great, thanks everyone. Great to have you online.